U.S. Finance 2026. Resilience or Risk. Lower Manhattan, February 2026. As the winter chill lingers over the Hudson River, a different kind of atmosphere is settling over the world's financial capital. It's not a panic, but it's not exactly a celebration either. It's a moment of watchful waiting. If you look at the headlines from 2 years ago, everyone was bracing for impact. The Great Recession that was promised by every major analyst seemed inevitable. Yet, here we are in 2026, and the American economy has proven to be far more stubborn than anyone anticipated. We aren't in a free fall, but we aren't soaring either. We are walking a tightrope, a delicate balance between cooling inflation and sustaining growth. In this video, we're going to peel back the layers of the 2026 financial landscape, from the quiet halls of the Federal Reserve to the chaotic trading floors of Wall Street, and finally, to the dinner tables of average Americans. This is the story of an economy that refuses to break, but is beginning to bend under the weight of a new global order. At the heart of this story is the Federal Reserve. For years, Jerome Powell was the most scrutinized man in the world. Every word he uttered sent shockwaves through the markets. But in early 2026, the tone has changed. The Fed has entered what economists are calling the Great Pause. The benchmark interest rate currently sits between 3.5% and 3.75%. To put that into perspective, it's a world away from the near-zero rates of the pandemic era, but it's also a significant step down from the aggressive peaks of 2023. The goal was a soft landing, bringing inflation down without destroying the labor market. So far, the data looks promising. Inflation has stabilized at around 0.4%. It's close to the Fed's 2% target, but that last 0.4% is proving to be the hardest mile to run. Why? Because the cost of services, housing, and insurance remain sticky. The Fed is in no rush to cut rates further, fearing that a premature move could reignite the inflationary fire. They are playing a game of patience, waiting for the economy to fully absorb the shocks of the last 5 years. Now, let's look at Wall Street. If you glance at the S&P 500, things look spectacular. Earlier this year, the index hovered around the historic 7,000 mark. But look closer, and you'll see that the engine driving this growth has changed. The Magnificent Seven, the tech giants that carried the market for a decade, are no longer the only players in town. We are witnessing the Great Rotation. Investors are becoming more discerning. Artificial intelligence is still a massive theme, but the AI gold rush has matured. People aren't just buying chips and software. They are looking for the companies that are actually turning AI into profit. Meanwhile, the old economy is making a comeback. Energy, industrials, and infrastructure stocks are seeing a surge. As the U.S. reinvests in domestic manufacturing and green energy grids, these forgotten sectors have become the new darlings of institutional investors. It's a more diversified, perhaps healthier market, but one that is highly sensitive to geopolitical shifts. However, no story about 2026 is complete without mentioning the wild card, trade policy. We are living in an era of new protectionism. Tariffs have become a primary tool of foreign policy, and the ripple effects are felt everywhere. As new trade barriers go up, the cost of imported goods stays elevated. This is the sticky inflation the Fed is so worried about. For a multinational corporation, the supply chain is no longer about finding the cheapest labor. It's about finding the safest geopolitical partner. We call this friendshoring. This shift has created a tug-of-war in the markets. On one hand, domestic manufacturing is booming as factories return to American soil. On the other hand, the cost of living for the average consumer remains high because the era of cheap global goods is effectively over. Every tweet from Washington or news alert from a major port can move the markets by 2% in a single day. Uncertainty is the only certainty. So, where does that leave us? The U.S. economy in 2026 is a study in resilience. It has survived a global pandemic, a historic inflation spike, and a total restructuring of global trade. For the investor, it's a time for caution and diversification. For the consumer, it's a time of adaptation. We are not heading for a cliff, but we are also not on a smooth highway. We are on that tightrope, carefully placing one foot in front of the other. The American dream isn't disappearing. It's just getting more expensive and more complex. But if history has taught us anything,
a 20%
it's that
growth
this
by
economy
Q3.
has a remarkable ability to reinvent
agree.
itself when its back is against the wall. What is your take on the 2026 economy? Are you optimistic about the market's resilience? Or do you think the tightrope is about to snap? Let me know in the comments below. Don't forget to like and subscribe for more deep dives into the world of finance. I'm your narrator, and thank you for watching.